of a computer science background, or maybe you've come straight out of business school, and you're coming into this fresh, right? So you still, you do need to estimate paying yourself if you're going to go down this route, right? It's another thing that you're going to be having is, a lot of your expenses are going to be in the cloud, right? So you're going to have Amazon Web Services. With Amazon Web Services, there are a lot of startup resources where you can get credits for this, whether it's through an accelerator program or different vendors that you may be using. Those are always helpful. You may be paying for a GitHub repository or G Suite or Zoom, etc. Rent, that's a funny one at this moment, right? There's a lot of rent, people trying to get out of paying rent, especially businesses. This is one where startups, most startups that we work with, even at the seed stage, they run distributed teams. So, you may be here in New York, but maybe, you have a co-founder in Florida. You may have someone else in California or Boston, or Colorado. So your team may be all over the place. And sometimes your team members may want to use co-working space or some space where they're going to be storing stuff. So rent is another thing that you may have to factor in, even in the current environment. Sales and marketing, this is another one where, there's digital conferences and trade shows. How much are those things going to cost? And then, you have the website development of building your platform, like whether it's a SaaS product or an e-commerce platform, or whether it's in a different area such as AI or machine learning. But then you're also going to have your customer-facing website development that you're going to have to do as well, and that's going to have a tangible cost to it, right? And then driving customers to that. How are you going to do that? What I find generally is a lot of tech founders have great networks that they're coming from already, and they can generate a lot of organic growth, either through PR or through their existing networks. But then, there are folks who need to invest early on in SEO and other digital marketing efforts. And what is that going to cost, right? So I think these initial costs that you're going to have, you've got to think through, and budget them out, so that as you build your product, you're going to have a good idea of what it's going to cost, and ultimately, it's going to inform your fundraising process. The next thing I wanted to get into is just terminology, especially with early stage tech. There's definitely a difference between finance terms and accounting terms. So some common finance terms that you may hear is MRR. Does anyone maybe in the chat box want to say what that is? I'll just give you guys a minute. ARR, runway, run rate, burn rate, churn, LTV, CAC, and EBITDA. So it looks like Jennifer mentions, monthly recurring revenue, right? That's what MRR is. ARR, so it's not monthly, then it's annual recurring revenue. Runway, that's generally the time that you have left as far as how many months of cash you have. So that could be 6 months or 7 months of runway. So that's a common term that you'll hear. Run rate is generally how much revenue you are estimating in a calendar year, and it could be expressed in terms of months or over a year. Burn rate is how much, generally how much cash you have and how much cash you have left to get you through the next 6 to 12 months. With a lot of our clients, it was through this COVID pandemic, it was really a case of musical chairs. Like depending on when you decided to fundraise, some of our clients got lucky. They fundraised right at the end of last year or the beginning of this year, and they now are sitting on enough cash to get them through the next 12 to 24 months. And then there's others who were sort of towards the end, and they were going to get into their fundraising cycle in the summer, and they are now in more of a challenging fundraising environment, right? And the folks of, some of you on the call are going to be at different stages of that. Churn, this is generally either downgrades or, customers who are canceling their subscription. LTV is another really important metric that you'll hear, which is the lifetime value of your of your customers, right? So from the time that they sign up on your platform till when they leave, right? What is that time frame, and how much is that customer going to be worth? CAC is customer acquisition costs. So this is another really important metric, like how much in Facebook ads do you need to spend to get your customers, or how much in Google ads are you spending, etc. EBITDA, this is earnings before interest, tax, depreciation, amortization. And this is a metric that a lot of people in finance will look at to see how your company is operating, as far as without taking into account those sort of fixed costs like taxes and depreciation. Now I'm going to get into accounting terminology. And some of these you may have heard of. Deferred revenue is a very common one, especially amongst companies that are doing software as a service or e-commerce. And the reason for this is someone may pay you today let's say they pay you $1,200 to use your platform for the next year. You may not be able to recognize all that as revenue today, right? Because you owe them service over the course of 12, 24 months. So the accounting term for that is you would have to record that as a liability on your balance sheet as deferred revenue and recognize the revenue over time, which gets us into revenue recognition. The next term, very often with startup founders, they're very focused in on MRR, ARR, and there's a bit of a disconnect in the way that's reflected versus revenue recognition, where you would be recognizing revenue over time as you deliver services to your customers. COGS, I think, does anyone know what that is? You want to type that in, and then we have gross profit, net income, GAAP, which is generally accepted accounting principles, retained earnings, which is sort of your year-to-year earnings or losses that seem to accumulate each year. And another thing that you'll also probably hear is convertible notes, especially in this environment where people will be raising money in the form of a convertible note that then converts into equity. And sometimes with first-time founders, they may book this as equity or straight away or as revenue when it should really be booked as liability. So COGS, that's cost of goods sold. This is a really important metric for you to know how much it costs to manufacture and sell your products. So especially important for e-commerce companies, but also for SaaS companies as well. This is important because you may be paying for Amazon Web Services, or if you're a fintech company, you may be paying for a service like Plaid, and all these services have a different cost to it that you can then attribute to the monthly revenue that you're earning. So revenue, COGS, gross profit, these are sort of the three really important things that you need to know as a founder so that you can make a business case for your product or service. Because if the business is not generating a gross profit at the bare minimum, you don't necessarily have to be positive cash flow or positive net income, but generally, investors are going to want to understand how you see gross profit over time, right? So for some founders, you may not have positive gross profit in the beginning, but over time, you definitely want to make the business case for it. And especially in this environment, you kind of want to hit the ground running and show that, your gross profit margins are positive and healthy, and that, with a little bit of investment, which will act as jet fuel, you can push your startup to the next stage. So yeah, that gets me to, from an accounting perspective, the three main financial statements, which are balance sheet, income statement, and statement of cash flows. These are the three financial statements that most founders need to get comfortable with and understand what each one, what the purpose of each one is. The balance sheet is what your financial picture looks like at any point in time. So generally, this financial statement will show three main areas: assets, which would be like your bank accounts, receivables, equipment that you have, security deposits, etc. It will show your liabilities. So that would be credit card debt. A lot of tech founders may use a law firm to help them fundraise, and they don't they're getting bills for, all of that time is being accrued and billed, and you may not pay it out, but you need to recognize that as a liability. When you raise money in the form of a convertible debt, you generally book that as a liability. And then your equity, right? So founders will generally set themselves up to be issued common stock, and generally investors get preferred stock. You will have an option pool for your employees. And as I said, there'll be a retained earnings, which is sort of your accumulated losses and earnings each year. So just to show you an example of what a balance sheet would look like, here is a sample financial statement. So here, as you can see, here's your bank account. And as you can see here, this is a financial statement by month, so you can see how the company is doing. So at the end of the year here, it was at $287,000 in cash. There was fixed assets, which would be like equipment, of $22,000, and total assets of $315,000. On the liability side, there's accounts payable, and there's no debt here on this company, and there's equity here of $311,000. So this is just an example of what a balance sheet would look like, and some of you may have already seen something like this. So when you're putting together your financial model, you probably will need to project out what a balance sheet, what you estimate your balance sheet to look like on a month-to-month basis. And a balance sheet really gives you a view of how healthy your company is, right? Because if you have a lot of debt and not that much in assets, that paints a picture of how your company is doing, right? Versus if you you may, for a lot of tech founders, they may be showing a healthy amount of cash and a healthy amount of equity, which also paints a different picture. The next financial statement is the income statement. So the income statement is usually not at a point of time, it's more a period of time. So this could be like January through December, or like the calendar year, or you may be on a fiscal year. So this would be measuring your revenue over that time, your cost of goods sold, your gross profit, and your expenses, and ultimately your net income. So let me just show you a sample income statement by month here. So as of end of 2019 here, we see that there's revenue of $392,000. Cost of sales is $76,000, gross margin of $316,000. So this is a healthy gross margin that can cover operating expenses. There's currently a storm going through Queens, so if you hear some background noise, pardon that interruption. Operating expenses. So here we have general administrative expenses. Typically, you'd have like your compensation here, your rent, sales and marketing, etc. And just to go back, you would typically have your operating profit, your interest and taxes, adding back your depreciation and amortization to get to your EBITDA. But your net income is essentially what you want to see here. So here you can see this is in parentheses. So this company is actually in the negative, which is not, for tech companies is not uncommon, right? What we generally see is most tech founders or tech companies are running negative net income for sometimes the first 3 or 4 years of their operations. And it's generally, as long as they can make a business case that their gross margins are healthy, generally the losses are helped fund, they're subsidized by the investments that tech founders are raising. In this new environment with COVID, I'm not sure how patient investors will be as far as that goes. I think they'll definitely want to see a positive gross margin. And even if your net income is negative, you'll as long as you could show like some sort of a positive trend, that it's sort of trending upward, or a lower lower loss each month or each year, I think that's going to be what's going to sort of set the target so that you can move through the fundraising cycles from pre-seed to seed to Series A, Series B, and further financing rounds. The next statement is the statement of cash flows. And this is kind of similar also in that it's over a period of time. And this sort of measures your beginning cash, your ending cash, and the different changes to your cash, which are sort of through operating activities, investing activities, financing activities, etc. And there's two methods for this. There's a direct method and indirect method. And I think for tech founders, the indirect method is a bit esoteric and it doesn't really jive, but the direct method is really helpful, especially when you're getting started in projecting out cash. So, some of you founders, they may be starting off with $1 and a dream, right? So they have $1,000 in the bank account. That's where they're going. And maybe you can project out your cash flows by month. So here we have a calendar year of 12 months, and we have the cash on hand here at the top. And then we have basically cash receipts, that's money coming in, and cash paid out, money going out. And what do you have at the end of the year? And I find for people who aren't familiar with accounting, this type of layout really helps them understand things in simple terms, right? How much money do I have at the beginning of the month? How much went out? How much came in? And what do I have at the end? And if you use a spreadsheet like this, which feel free to contact me. I'll put my contact details at the end, but feel free to reach out to me and I could send you like a template of this. But essentially, something like this would help you project out your expenses. So let's say right now we're in August. If you wanted to project out the next 12 months, you can start in August. How much do you have in the bank? And then just sort of project out how you think you're going to do over the next 12 months and how much cash you're going to have on hand. And this will be a useful way for you to budget your expenses, right? So your cash paid out here shows what you're spending your money on, whether it's payroll, advertising, rent, taxes, payroll taxes, etc. Right? You can sort of list it all out, and especially for those of you companies that may be in the product development stage of building out your platforms, and you're more just building out the product at the moment. You're not going to really have that much money coming in. You may have been fortunate enough to get into a tech accelerator program like a Techstars, and they may have given you $20,000 or so to just get to an MVP, and you're trying to get to demo day in the next 3 months. So you may have a few expenses, right? So this is a useful way to sort of lay out your projections. I find the direct method of doing the statement of cash flow is really useful for people not familiar with accounting. You can just lay out your spending on a spreadsheet and summarize what you think your total expenses are going to be. And this gets us into sort of, how do you do that, right? Like how do you estimate what your expenses are? And I think a lot of that has to do with making assumptions. And you make assumptions to project out sales, you make assumptions to project out your gross profit margins, your operating expenses. And what you really want to do is treat this as a living, breathing document that complements your accounting and budgeting, and not what I typically see is founders use this just during the fundraising process. They'll develop a financial model. And there are a lot of templates out there online. I can send you some. Feel free to reach out to me if you're looking for a financial model template. They're generally Excel workbooks with multiple tabs, and you kind of have different drivers, revenue drivers, payroll drivers, operating expense drivers. And what you're trying to reach is essentially, you want to be able to tell a story through numbers of how your company is projected to do over the next 12, 24, 36 months. Typically, when you're fundraising, investors want to at least see 2 to 3 years. And that also depends if you have some history. They can also use some of that to project out. Beyond that, it's really hard to project out any further than that. And I think most savvy investors recognize that a financial model can only do so much. It's sort of like something that they want to have, but it's not necessarily going to be something that you are going to be expected to update every day. But to expand your team, one of the things that I find helpful and what I encourage the founders I work with to do is to sort of delegate this. So let's say you hire a VP of sales, or if you have a CFO or CTO, let them take ownership of different parts of your financial model. So for instance, if you have a VP of sales, after you raise a Series A or seed round, let them take over the sales projections, right? If you're going to have a CTO, some of you are CTOs, or, have a technical background, or consider yourselves as, you're going to be responsible for what your product engineering payroll is, and what the technology team, what that payroll is going to be over the next 12 to 24 months. So once you build out a financial model, it's really trying to delegate it out. Especially once you fundraise, you want to delegate out the responsibility. And that way it becomes more of a living, breathing document. I mentioned some of the drivers. So, how much in revenue, what your product development timeline is. If you're going to set up the product, if the product development timeline is the next 12 months to get to a beta, or to get to an MVP, and then from that point on, I know many startup founders are on sort of like the agile methodology, where they're continuous development of their product and rolling out features. So it just depends where you are in that timeline. You can also project, another big driver is your customer acquisition costs. And a lot of the financial models have ways for you to estimate that, your employee costs, your cost of goods sold, your gross margins, and then your LTV, lifetime value of customers. And ultimately, what you want your financial model to do is distill to this sort of financial summary. It's a one-page snapshot that sort of shows, okay, how are you doing beginning cash? How are you doing on your financings? What is going to be your total revenue per quarter or per month? What are you estimating your gross profits and your gross profit margins to be? And as far as operating expenses, I find that investors really want to see these rolled up into three main categories: selling expenses, G&A. So selling expenses would be Google spend, Facebook spend. If you hire a VP of sales or marketing, their sort of salaries would be included in there. General and administrative. So this would include the officer salaries, legal, finance, accounting expenses, R&D and engineering. So this would be the product development team and the CTO and people who are actually working on developing the product. So you want to be able to distill it into these three big buckets and sort of summarize your expenses into those three buckets, which would give you a total sort of operating expense. You then would have your ending cash and then sort of your burn rate. So this is what you would want to sort of show and project. So you would want to show what your actuals are and then forecast it out as well, at least over the next 12 months. And if you can show your investors a snapshot like this, and they can see like what your headcount is in those three main areas, in the R&D and engineering area, in the sales and marketing area, in the G&A area, they'll have a snapshot now of how your company, how you plan to grow your team, how those expenses are going to be growing as you grow your team, and how that's going to change your burn rate, right? So in this case, this company raised a $4 million round in Q4. So they're going to be using that money to grow in 2019, as you could see here. And you could see by the end of the Q4, they're estimating their total revenue to be around 600,000. So you want to be able to tell a story through numbers, and especially when you're fundraising, you want to make that story to be distilled in as straightforward way as possible. And you want to really show revenue, cash, how much cash you need to stay alive, revenue over time, operating expenses over time, and sort of headcount and how you see that evolving over time. So now I'm just going to get into, maybe I'll just pause for a second. Was there any questions, or anyone have any, or Josh, is there anything that you want me to touch on before I move on?
I don't believe so. I don't see anything in the Q&A box. Can you hear me?
Yes, I can hear you. Can you hear me?
Oh, okay. Yeah, okay. I can hear you.
All right.
No questions.
Okay, perfect, perfect. Yeah, if anyone has any questions, feel free to send them in. Because I know some of this stuff could seem very abstract, or if you need to clarify anything I've walked through, let me know. The next thing I was going to go through was sort of startup revenue recognition. So for like a traditional business, like let's say you're running a restaurant or you're running um, a storefront, right? A retail storefront. You know, many of these businesses sort of use the cash basis of accounting, where you sort of you recognize revenue as you earn it, right? As money comes in, and you recognize your expenses as you spend it as money goes out. But for tech founders, what you'll see is that you're going to be expected to keep your financial statements on the accrual basis of accounting, or GAAP, generally accepted accounting principles, and you're going to be having to show revenue as it's earned. Meaning, so if you, as I gave an example earlier, if you sign up a contract or a customer today, it could be a 12-month contract, it could be a 24-month contract. You're going to have to record that revenue over time instead of just recording the revenue today, right? So that's just one key difference in the way a traditional small business owner would operate compared to a early stage tech founder. So just something that you'll have to get used to as you build your company. MRR, we kind of touched on this earlier. There's different types of MRR. So there's new customer subscriptions, customers that may be upgrading. So that's just terminology that you got to get used to using, and downgrades or churned MRR. And then just sort of one thing I just want to highlight, I've sort of mentioned earlier, is that MRR is not the same as revenue. So this is something that a lot of founders sometimes find difficult to understand. There is a difference there. And I kind of give an example here. So MRR, you have 5 customers paying you $50 a month. So your monthly recurring revenue would be $250. ARR, so if a customer pays you $5,000 for a 2-year contract, your ARR would be equal to $2,500 per year, right? So that'd be 5,000 divided by 2. Deferred revenue, I gave this example before, but you know, if you record a client pays you $1,200 today for an annual subscription, you would record $100 at the end of each month, and there will be a liability on your balance sheet of about $1,100 each until you clear out that contract. So I've discussed this. So, you know, giving a real life example here. So here's like Dropbox. You know, they give you know, they will either let you pay for their platform on a yearly basis or build monthly. So for those of you companies that may be thinking about software as a service, this is sort of, there's different ways to bill, and depending on how you bill, on the accounting side, we would have to recognize the revenue in a particular way. Anyone recognize the skyline? It's not the most popular skyline. It's not like the New York City skyline. This is the skyline for Delaware. And the reason why I bring up this Delaware skyline, because I'm going to shift into the tax side of things now, in this side of the presentation. We have about 15 or 20 minutes left. I'm going to quickly go through a couple of tax things, maybe for the next 5-10 minutes, and then I'm going to open it up to Q&A. But most early stage tech companies are incorporated in the state of Delaware. There's a favorable court system there, but more than that, I think it's sort of like the lingua franca, the common sort of tongue that tech companies and most Fortune 500 companies use. And most companies are sort of set up there. Depending on where you are in your fundraising cycle or where you are in your product development cycle, typically I usually recommend, and you would have to consult with an attorney here, but I generally recommend the Delaware LLC, whether that's single member or multi-member, if you have co-founders, as the sort of de facto setup, especially if you're going to be thinking about raising venture capital. And I wouldn't, if you're not at that venture capital stage yet, I generally wouldn't recommend the C Corp unless there's foreign shareholders, which is something that typically happens. The good thing about the LLCs, especially for some of you, let's say you just left your you left your 9 to 5, and you're thinking about going into the startup world. You can pass through losses. So if you're going to spend $20,000 on product development the next 12 months, and you're not expecting any customers, any revenue as you build out your business, you can then offset that against your other W-2 income or other income sources. So the LLC is a part. The default is the tax classification is a pass through, so you can offset that against your income. Sometimes what I see is early stage founders rush to set up the C corp, but then when they invest their money into it, they don't get a tax benefit of that. So I generally, from a tax point of view, say set it up as a single member Delaware LLC, and I say Delaware because then later on once you are ready to do that venture round, you can easily convert it into a C corp, or the attorneys can help you with that. Sometimes I've seen companies do that the day that they get funding, they convert their companies. If you are going to be signing a vesting agreement, you're going to have to file an 83B election. So if you have a founder agreement, especially with you and your co-founders, generally there's a 4-year vesting, 1-year cliff. And this is a really good way to sort of set accountability so that, the people that you're setting the company up with, they are receiving their shares over time instead of all up front. And if they leave in the first 12 months, they don't get anything. So that's something that you need to discuss with your accountant and attorney as well. Some tax benefits for tech startups. There's R&D tax credits, which can be worth as much as 10% of eligible salaries. Here in New York, there is a Startup New York tax program where you can get up to 10 years exemption on some New York State payroll, income, and sales taxes. And then for companies that are not in the Startup New York program, there is a qualified emerging tech company employment tax credit, where you can get $1,000 tax credit per employee for any net new jobs created. And that credit's available for the first 3 years. So if you're thinking about setting up shop in New York, there are some benefits and yes, some things to consider. Also with tax reform, the corporate tax rate now is down to 21%. I'm going to skip some of this part because I don't think it's going to be too relevant to our discussion, but I'm going to leave it in the slides here, and I believe Josh is going to share this with everyone later. And also just something to consider with net operating losses. A lot of companies, tech companies, do generate net operating losses. This kind of going back to the income statement I showed earlier. When your net income is negative, for tax purposes, you're going to have a net operating loss, which you can carry forward. And with the most recent tax reform that passed about 2 years ago now, that can now carry forward indefinitely. And any NOLs generated, which is net operating loss generated after 2018, you can use up to 20% of those, 80% of those against taxable income for those of you generating profits. This next page, I'm showing Michael Jordan and Jack Nicholson here because entertainment, he's a big Laker fan. Entertainment expenses are now sort of disallowed, so you can't really take your client to the ball game or an investor to the ball game and expect that to be deductible. Meals continue to be deductible, and now with the most recent COVID crisis, they may, with restaurants being decimated, they may actually increase the deduction. Right now, it's a 50% deduction for meals. You may be able to deduct it 100% going forward. I'm going to skip this qualified business income discussion, but there is some new stuff in the tax reform where if you are generating some profits, you may be able to get a qualified business income deduction. I'll leave this example in the slides, but if anyone has questions about this, you can get to me. Some tax deadlines that you may need to consider going forward next year. This year, the tax deadlines got pushed back to July 15th. Typically, the tax deadlines for corporations is April 15th, and for LLCs and single member LLCs, April 15th. For partnerships, it's generally March 15th. If you are going to be incorporating in Delaware, generally there's a March 1st state annual filing requirement. And the reason I show these tax deadlines is, once you do set up your company, you do have to be cognizant of these tax deadlines. So having a good attorney, a good accountant, will help you stay on top of all these compliance deadlines. Some founder tax considerations, just the new law is, the highest tax bracket is 37%. So, if you are going to be setting up salary for yourself in the new company, you want to look at, where that's going to leave you as far as tax bracket, right? So, maybe the average tax bracket here in New York City is sort of between 82,000 to 150K. So, a lot of New Yorkers are sort of like in the 24% tax bracket. And sometimes what happens is if you start your company, it may also be a good time for you to look at, hey, maybe I can put some money from my 401k or into a Roth IRA, or and there are some tax considerations, especially for some of you founders moving over from corporate America into the tech world, that you may be able to take advantage of, especially the first couple of years when you're not really taking a salary and you're just sort of investing in the company. So, some things to consider here. Other considerations for founders is, especially for those who have kids, maybe considering 529 plans. And there are some state and local taxes that are capped now at 10K for single or married filing joint filers, which definitely impacts us here in New York City because we pay a lot in real estate taxes, especially those in Suffolk County, Nassau County, and upstate in Westchester County, and we get impacted by that, and that's also something that may change under the new stimulus plan, which we'll soon find out if they'll relax some of those rules, because that will definitely help us here in the Northeast. The R&D tax credit, as I said, that is a benefit for early stage founders. And one of the good benefits of this is you can get a cash benefit that this would actually offset payroll taxes. So if you are running payroll, if you're planning to have payroll, the 10% payroll tax credit will actually offset your self-employment FICA taxes, and you'll be able to get a current year benefit of that. And there's a 4-part test to qualify. You have to make sure that you're creating a new product, a new process, new software, which many early stage tech companies are. There has to be a degree of uncertainty, process of experimentation, and it has to be technological in nature. So a lot of companies, they have to be computer science, engineering, physical science, and biological sciences to qualify. If it's outside of those sort of 4 main disciplines, it wouldn't qualify. And internal use software could sometimes qualify. So this is another thing to look at. I'm going to skip some of these slides and just go to the COVID-19 resources. So 2 main programs that I believe the QEDC is doing seminars about are the Paycheck Protection Program. The one thing that I would just say for this, for those of you who are considering this or have already received it, is that there is forgiveness element of this. So if you have ran payroll in 2019, you are, or earlier in 2020, you are eligible for the Paycheck Protection Program. And for those of you who are thinking about it, there is a forgiveness element of it as well. So a lot of the loan can be forgiven. The other thing that some companies are looking at are these EIDL, Economic Injury Disaster Loans. And some companies have been receiving grants up to $10,000, and then loans up to $150,000 as well are being currently issued for those of you who may have started your companies in previous years. One thing for early stage tech companies to consider about this is any PPP loans given above 150K will be disclosed publicly by the SBA. There's actually a database right now that you can look at who's been given money, especially if you were given over 150K. So that's something just from a PR standpoint, you may want to be cognizant over, especially if you're venture backed. And then for companies taking EIDL loans, founders will have to personally guarantee any loans above 25,000. So that's something else you may not want to do. So it's something to think about. And then for companies that may be considering venture debt, they have to pay back the EIDL loans before they can take on any venture debt. So venture debt is something that sometimes comes along around the Series A, Series B stage. Some of you may be a lot earlier than that, so may not have to think about that. And sort of where to go from here. I think finding a good CPA, a good attorney is always a good way to go. And then from that point, finding the right software tools that you want to use. There's so much out there. The de facto that we kind of go with is QuickBooks Online, as far as organizing your accounting, but there are other solutions out there that you can use. And just a little highlight on our services before I go to Q&A. We offer tax compliance, preparation of tax returns, R&D credit calculation, sales tax returns, payroll taxes, and international tax issues for founders. And on the accounting side, we help with due diligence requests, financial statement preparation, helping with your financial model, and board and investor decks. So at this point, I wanted to turn it over to Q&A since we have about 10 minutes left. And maybe Josh, if you have any questions or anything that you think people have. I think Josh, I don't know if I'm the only one having trouble hearing you.
What about now?
Oh yeah, that's perfect. There we go.
Okay, yeah, I was on mute. Okay, so we'll take a few minutes for questions. If anybody has any questions, make sure to type them in the Q&A box, not the chat, just so we don't miss them. In the meantime, I have a question. Are there any common oversights you see your clients do? Something you see over and over again?
Yeah, so the question, any common oversights? Yeah, I think I think for early stage tech founders, sometimes they commingle funds. So they may be using a personal bank account to keep track of their expenses. And I think probably a good practice is, to set up a business account to keep your business separate from your personal, because it can be very difficult to then, at the end of the year, figure out, what you spent personally versus what you spent on the business, especially for people at a very early stage. It could be an issue. And then I would say for the ones that maybe a little bit further along at the pre-seed or seed stage, they may have set up a QuickBooks account, but they're so focused in on product development or getting customers that they sort of abuse keeping their bookkeeping up to date. So I think that's another common one for those who are maybe a little further along. They're past that point of they have the business account, they have the credit card accounts, they have a QuickBooks, but they just don't update their records on a frequent basis. So I think that's one that is a big one.
Keep on updating everything.
Yeah.
All right. Well, it looks like no more questions. So Shay put his contact info. Definitely contact him if you need help. And would you mind putting the QEDC information on the page?
Oh, yeah, sure. Here we go.
And here's our contact information. If you have any general business questions, if you need help with anything, please feel free to contact us through our website or through our Facebook group, which I sent the link. No questions? All right. I think that's it. Thank you, Akshay.
All right. Thank you, guys. And feel free to reach out to me if you have any questions, or feel free to reach out to Josh at the QEDC. Thank you.
All right. Have a good afternoon, everybody.
All right. Bye.